The global economy stands at a critical juncture, marked by unprecedented shifts in power dynamics, monetary policies, and societal values. As traditional financial systems face challenges from inflation, debt, and geopolitical tensions, individuals seeking to build wealth must navigate a complex and rapidly evolving landscape. This video provides a comprehensive exploration of the principles and strategies for achieving financial independence, drawing on insights from macroeconomic trends, the psychology of wealth, and practical approaches to investment and entrepreneurship. It is designed to empower young professionals and aspiring entrepreneurs across diverse economies, spanning North America, Europe, Asia, Africa, and Latin America, with the knowledge and tools to thrive in an era of uncertainty. The discussion is structured around three core pillars: understanding the global economic environment, cultivating a wealth-oriented mindset, and implementing actionable strategies for financial success. The global economic order is undergoing a profound transformation, driven by the rise of emerging economies and the rebalancing of power between East and West. Coalitions like BRICS, Brazil, Russia, India, China, and South Africa, represent a growing counterweight to Western dominance, with their combined populations and resources challenging the primacy of the US dollar as the world's reserve currency. This shift is not merely economic, but geopolitical, as nations vie for influence in a multipolar world. For instance, countries like Brazil and South Africa are leveraging their natural resources, while China and India drive technological innovation and demographic advantages. Meanwhile, established economies in North America and Europe face internal challenges, including aging populations, rising debt, and social unrest, which threaten their long-term stability. At the heart of this transformation lies the evolution of monetary systems. The 1971 decision to decouple the US dollar from the gold standard marked a turning point, transforming fiat currencies into debt-based instruments. This shift enabled governments to print money at will, fueling economic growth but also sowing the seeds for inflation and asset bubbles. In recent years, excessive money printing, particularly in response to economic crises, has eroded purchasing power, with profound consequences for the middle and lower classes. For example, in the United States, rising energy costs have strained household budgets, while in Europe, inflation has driven up the cost of essentials like food and housing. Similar trends are evident in Latin America, where countries like Argentina and Venezuela have grappled with hyperinflation, and in Africa, where currency devaluation has exacerbated poverty. Geopolitical tensions further complicate the economic landscape. The rivalry between major powers, particularly between the United States and China, has intensified, with trade disputes, sanctions, and currency wars threatening global stability. The potential for a major economy to peg its currency to gold or another tangible asset could upend the fiat system, triggering a collapse in currencies like the US dollar or the euro. Such a scenario would likely drive investors toward safe haven assets like gold, silver, and cryptocurrencies, as seen during past crises. Additionally, the risk of conflict, whether economic or military, looms large, as nations historically resort to war when financial systems falter. The ongoing conflict in Ukraine, for instance, has highlighted the interplay between geopolitics and economics, with energy markets and supply chains bearing the brunt of disruptions. Emerging economies are uniquely positioned to navigate these challenges, leveraging their demographic and technological advantages. In Asia, India's advancements in space exploration and digital infrastructure underscore its potential as a global leader. Similarly, Nigeria's youthful population and growing tech ecosystem position it as a hub for innovation in Africa. In Latin America, Brazil's vast agricultural and mineral resources offer opportunities for economic diversification. However, these nations must address structural challenges, such as bureaucratic inefficiencies, corruption, and outdated educational systems, to fully capitalize on their potential. For individuals in these regions, understanding global trends is critical for identifying opportunities and mitigating risks. Commodities play a pivotal role in this uncertain environment. Gold and silver, historically regarded as stores of value, offer protection against inflation and currency devaluation. Unlike fiat currencies, which can be manipulated by central banks, precious metals have intrinsic value and a proven track record of preserving wealth. Similarly, oil remains a cornerstone of the global economy, with price fluctuations impacting everything from transportation to manufacturing. Investors who prioritize commodities can hedge against economic volatility, as demonstrated by the rising demand for gold in Asia and the Middle East. Moreover, emerging asset classes like cryptocurrencies, despite their volatility, offer an alternative to traditional financial systems, appealing to tech-savvy investors in regions like Southeast Asia and Sub-Saharan Africa. The psychology of wealth creation reveals a stark contrast between the mindsets of the wealthy and the middle class. The middle class, shaped by conventional education, often adopts an employee mindset, prioritizing job security, saving money, and investing in mainstream assets like stocks and bonds. This approach, while stable, limits wealth-building potential, as individuals remain tethered to earned income and high taxation. In contrast, the wealthy embrace an entrepreneurial mindset, focusing on creating and controlling assets that generate passive income. This mindset emphasizes leveraging debt, minimizing taxes legally, and investing in tangible assets like real estate, businesses, and commodities. Today's education system is a critical barrier to financial success. Traditional school systems, whether in the United States, Germany, or India, rarely teach financial literacy, leaving individuals ill-equipped to manage their money effectively. Subjects like budgeting, investing, and tax planning are absent from most curricula, reinforcing a cycle of financial dependence. To break this cycle, individuals must take responsibility for their financial education, seeking out resources like books, podcasts, and investment courses. For example, in Singapore, a hub for financial innovation, young professionals are increasingly turning to online platforms to learn about wealth management, while in Brazil, community-driven financial literacy programs are gaining traction. Debt, often demonized in middle-class culture, is a powerful tool for the wealthy. Entrepreneurs use debt strategically to acquire income-generating assets, such as rental properties or businesses, amplifying their returns without relying solely on personal capital. In the United States, for instance, real estate investors benefit from tax deductions on mortgage interest and depreciation, while in countries like Canada, similar incentives encourage entrepreneurial activity. However, using debt effectively requires discipline and market knowledge, as mismanaged debt can lead to financial ruin. In emerging markets like India or Mexico, where rental yields may be lower than borrowing costs, investors must carefully evaluate local conditions before committing to debt-financed investments. Asset allocation is another area where the wealthy diverge from the middle class. While the middle class often invests in liabilities, such as primary residences that drain resources, the wealthy prioritize assets that produce cash flow or appreciate over time. Real estate, for example, offers opportunities for passive income and capital gains, particularly in fast-growing cities like Lagos or Bangalore. Commodities like gold and silver provide stability, while cryptocurrencies, despite their risks, have gained popularity among younger investors in regions like South Korea and Nigeria. Diversifying across these asset classes can mitigate risks, but each requires thorough research and an understanding of market dynamics. For young professionals aged 25 to 35, building wealth in today's economy requires a multifaceted approach. Financial literacy is the foundation, enabling individuals to make informed decisions about their money. This involves mastering concepts like cash flow management, debt structuring, and tax optimization. Practical steps include reading foundational texts on personal finance, listening to podcasts by seasoned investors, and participating in investment simulations or board games that mimic real-world financial scenarios. In countries like South Africa, where financial education is increasingly prioritized, such resources are helping young people bridge the knowledge gap. Networking is equally critical. Surrounding oneself with successful, like-minded individuals fosters inspiration, mentorship, and collaboration. In hubs like London, Singapore, or Sao Paulo, industry events and investment clubs provide platforms for connecting with entrepreneurs and investors. Online communities, accessible through social media and professional networks, allow individuals to tap into global expertise regardless of their location. Building these relationships requires authenticity and a willingness to contribute value, whether through sharing insights or supporting others' ventures. A clear financial mission is essential for long-term success. Young professionals must define specific, measurable goals, whether achieving financial independence, launching a startup, or building a real estate portfolio. This clarity drives decision-making and fosters resilience in the face of setbacks. In Japan, for instance, where cultural emphasis on discipline and planning is strong, young entrepreneurs are setting ambitious goals to disrupt traditional industries. Similarly, in Kenya, the rise of mobile-based startups reflects a generation's determination to seize technological opportunities. Strategic use of debt and tax advantages can accelerate wealth creation. In many countries, tax codes incentivize entrepreneurial activities, offering deductions for business expenses, real estate investments, or research and development. Consulting with accountants and attorneys is crucial for navigating these opportunities, particularly in complex markets like India or Brazil, where regulations vary by region. When using debt, the focus should be on acquiring assets that generate sufficient cash flow to cover obligations, such as rental properties in high-demand areas or businesses with scalable models. Choosing the right asset classes requires aligning investments with personal goals and risk tolerance. Real estate remains a cornerstone for wealth building, offering both income and appreciation potential. In cities like Dubai or Miami, where property markets are booming, investors can capitalize on high rental yields and capital gains. Commodities like gold and silver provide stability, particularly in inflationary environments, while cryptocurrencies appeal to those willing to navigate volatility for potential high returns. Business ownership, whether through startups or investments in established firms, offers the greatest potential for wealth creation, but demands entrepreneurial skills and risk management. Career and investment choices play a pivotal role in shaping financial outcomes. While traditional careers offer stability, they often limit long-term wealth potential, as individuals become trapped in cycles of earning, spending, and borrowing. In contrast, entrepreneurial paths, whether starting a business or investing in side ventures, provide greater control and scalability. Young professionals should prioritize skills development, focusing on areas like sales, negotiation, and financial analysis. In emerging economies like Vietnam or Colombia, where entrepreneurship is on the rise, these skills are driving a new generation of wealth creators. Preparing for economic uncertainty is critical in today's volatile environment. Building an emergency fund, investing in safe haven assets, and staying informed about global trends can protect against downturns. For example, in Australia, where economic stability is bolstered by commodity exports, investors are diversifying into gold and real estate to hedge against global risks. Similarly, in Europe, where energy crises have heightened economic concerns, individuals are turning to cryptocurrencies and precious metals for security. Ethics and integrity are non-negotiable pillars of sustainable wealth creation. Building wealth legally and morally ensures long-term success and personal fulfillment. In markets like Singapore, known for its stringent regulations, ethical business practices are a competitive advantage. Similarly, in Africa, where social entrepreneurship is gaining traction, creating value for communities enhances both financial and social capital. Young professionals should prioritize honesty, avoid exploitative practices, and seek to make a positive impact through their ventures. Emerging trends offer exciting opportunities for wealth creation. The rise of digital economies, driven by advancements in artificial intelligence, blockchain, and renewable energy, is reshaping industries worldwide. In Southeast Asia, countries like Indonesia and Thailand are leveraging e-commerce and fintech to drive economic growth. In Africa, mobile banking and agri-tech startups are transforming underserved markets. Education technology is another growth area, with platforms offering financial literacy and entrepreneurial training gaining popularity in regions like Latin America and South Asia. These trends underscore the importance of adaptability and continuous learning in a rapidly changing world. The interplay between technology and finance is particularly transformative. Blockchain-based assets like cryptocurrencies offer decentralized alternatives to traditional banking, appealing to younger generations in regions like South Korea and Nigeria. However, regulatory risks such as the introduction of central bank digital currencies, CBDCs, could disrupt these markets. In countries like China and India, where CBDC pilots are underway, investors must stay vigilant about policy changes. Meanwhile, advancements in artificial intelligence are streamlining investment decisions, enabling individuals to analyze markets and optimize portfolios with unprecedented precision. Social and cultural factors also shape financial success. In collectivist societies like Japan or India, family expectations often influence financial decisions, such as prioritizing homeownership over income-generating investments. In contrast, individualistic cultures like the United States emphasize personal ambition, encouraging risk-taking and entrepreneurship. Understanding these dynamics can help individuals navigate societal pressures while pursuing their financial goals. For example, in the Middle East, where cultural emphasis on wealth preservation is strong, families are increasingly investing in diversified portfolios that include real estate and commodities. The global pension crisis is another pressing concern. In developed economies like the United States and Germany, pension funds are under strain, with many facing insolvency due to mismanagement and market volatility. This crisis highlights the risks of relying on traditional retirement systems and underscores the need for self-directed wealth-building strategies. In emerging markets like Brazil and South Africa, where pension systems are less developed, individuals must prioritize private investments to secure their financial futures. Ultimately, the path to financial independence requires a holistic approach, blending knowledge, strategy, and mindset. Young professionals must commit to continuous learning, leveraging resources like books, podcasts, and mentorship to stay ahead of the curve. They should seek out networks of successful individuals, whether through local events or global online communities, to gain insights and opportunities. By defining clear financial goals, using debt strategically, and diversifying across asset classes, they can build resilient portfolios that withstand economic turbulence. Above all, they must uphold ethical standards, ensuring that their pursuit of wealth aligns with personal values and societal good. The opportunities for wealth creation have never been greater, thanks to technological advancements and the democratization of information. From the bustling tech hubs of Bangalore and Lagos to the financial centers of New York and Singapore, individuals have access to tools and networks that can transform their financial futures. However, success is not guaranteed. It demands discipline, resilience, and a willingness to challenge conventional wisdom. By embracing these principles, young professionals can navigate the complexities of the global economy and build lasting wealth in an era of unprecedented change. If you found this article insightful, like, share, comment, and subscribe for more content on mastering wealth creation and navigating the global economy.